You're listening to certified financial planner Doug Goldstein, host of the Goldstein on Gelt show, www.goldsteinongelt.com.
Okay, I'm very excited to have on the Goldstein on Gelt show Professor William Black, who is the author of a really fascinating book called The Best Way to Rob a Bank is to Own One. So, of course, I read it because I was sort of curious about how to rob a bank and didn't really read the end of the title. But, well, Bill, it's a real pleasure to have you.
Thank you. It's a delight to be here.
So, of course, when people in financial shows joke about robbing a bank, I think listeners get a little bit nervous. Do you think normal people have to be worried about their bank deposits?
No, because bank deposits are insured, and that's one of the reasons they are insured, because one of the leading risks historically has been the guy who controls the bank. It's a whole lot easier to turn off the alarms, and they know the combinations. But in seriousness, the way you steal from banks big time is with accounting.
Mm-hmm. I want to get to that because that really is the topic, but I just want to go back to this insurance thing for a minute. You're referring to the FDIC, the Federal Deposit Insurance Corporation, which protects people today for up to $250,000 per account, right? That is what you were referring to, yeah?
In the U.S., but
US.
One of the important changes over the last 25 years has been the spread of deposit insurance to essentially all OECD nations.
That's interesting. Is it part of what they actually have to do, or is it just sort of part of, is it a tradition?
No, it's actually neither. At the same time that many economists were warning against deposit insurance, there's been an enormous move throughout developed nations to adopt deposit insurance and typically to increase the amount covered by that insurance.
So back in 2008, which is a topic you talk about a lot, I remember that people were actually, literally it was looking awful, and people said, well, the FDIC won't have enough money to bail out the banks. Was that just a scare tactic in the media, or was there actually something to that?
No, there was nothing to that because the FDIC is backed by the full faith and credit of the United States of America. So it doesn't matter how much is in the insurance fund. In the savings and loan debacle of the 1980s, for example, we were insuring an industry that had over $1 trillion in liabilities. And at our low point, this is a liquidity number, of course, as opposed to a net worth number, we were down to 500 million. So we were running on fumes. But there was still no nationwide run because everyone knew that the Treasury was good for the money. And of course, politically, if some congressman tried to pass a law saying, no, let's stiff the American people on that, the half-life of his political career would be measured in nanoseconds.
But it's not really an insurance, right? Because it's not true insurance. The banks are not paying a market-level premium in order to get coverage, it's really just a backstop that the government puts up and said, no matter what you guys do, we're going to come in and protect you.
It's not actuarially sound insurance, but there are in many countries efforts to make some degree of risk-based pricing. So it's not completely distinct.
Why wouldn't countries actually make risk-based pricing so it's a real insurance, so they'll let the banks actually pay for the insurance that they're getting?
Because they wouldn't know what price to charge. Because one of the great secrets of banking is how pathetic people are in evaluating risk, which, of course, is why we have these kinds of crises in advance. Or to phrase it the other way, the entire art from the standpoint of the CEO is to make it appear that the bank has trivial risk, while in fact taking extreme risks or the sure thing of, to quote George Akerlof, the Nobel laureate in economics, to loot the bank.
Mm-hmm. All right, I could actually talk about this all day because I have a lot of thoughts on it. But let's go back to what normal people would care about, which is how safe their money is in the bank. And you said there's nothing that people who put their money in the bank should feel that it's safe. So I'm putting those words directly on our guest today, Professor Bill Black, who wrote the book, The Best Way to Rob a Bank is to Own One. So now explain to me a little bit more, Bill, what did you mean by the way that money is being taken from banks is actuarially?
So let me be precise. I said if you're insured and your money is within the insurance limit, that you're not going to lose, right?
Good disclaimer. You just don't want our listeners to come after you. You said on the Goldstein on Gelt show. All right. So, up to the amount that they're covered, they should feel safe about.
Right. So in terms of insurance, one of the clear differences in the crisis, for example, was AIG. So AIG was the leading seller of credit default swaps. It typically referred to these things as if they were insurance, but they were, of course, not insurance. There were no reserves, there was no regulation, and you didn't need to have an insurable interest. In other words, we typically don't let you buy fire insurance on your neighbor's home because maybe that would create some pretty bad incentives. But with credit default swaps, which I may slip and call CDS, these things you could, 1,000 of us could buy fire insurance on your neighbor's home. And that really screws up actuarial type things, right? It's no longer the risk that a particular home will burn down. It's now the risk that that home will burn down times 1,000.
Let's take a time out here and just define what, maybe you could just define what is a credit default swap, because it's not something that individual investors normally buy. These are usually used by institutions.
So credit default swaps are not something you should buy yourself.
Don't try this at home.
Don't try this at home. This is a really good way to lose a lot of money. And that's why AIG went bankrupt and had to be bailed out by the United States Treasury. So supposedly, credit default swaps, you figure out the risk of something, which to be clunky, we call an underlying, which in the crisis was usually yet another acronym, and that was collateralized debt obligations, or CDOs. And these things were 80% of the typical CDO was rated AAA, even though, the average downgrade on them during the crisis was 20 credit grades. So AAA is the best you can get. It's equivalent to, actually above now the United States Treasury, but that's silly on the rating agency's part. The U.S. Treasury is AAA in any meaningful sense. Anyhow, AAA is the best you can, and this stuff was really much closer to the phrase the industry used, toxic waste. Single C means it's on the doorstep of default or already there, and no normal person should be buying that kind of stuff. It is way, way, way below the cutoff line for what are called junk bonds. Okay, so that's the thing that you're saying. I'm going to protect you from having any loss by selling you this CDS policy, credit default swap, and if it goes bad, something akin to assurance, AIG promise I will pay you for the loss in value on that AAA CDO. And these AAA CDOs, depending on the time period, often lost 60% or more of their market value. So that you could see that'd be a really big hit. So here's the remarkable thing. When you sold this supposed insurance, your AIG, you don't have to put aside any, zero reserves for losses, even though you're taking on the risk of that loss. And you pay the guy in charge a bonus immediately when he sells this CDS, quote unquote, protection. He's going to walk away with an immense amount of money, and he maximizes the amount of money he gets, his bonus, by selling more. And the way you sell a whole lot more of something in finance is to underprice us, which brings you back to that concept you asked me about, actuarial. In other words, you charge a whole lot less than the actual risks. People flood in AIG's doors to buy this underpriced CDS protection because ADS, had a AAA for a while during all of this.
Wait,
so they
ADS,
must be safe.
Which is ADS?
I'm sorry?
You said ADS had a AAA rating.
I did? I thought I said I meant to say AIG had a
AIG, right, okay.
AIG for a time, it actually lost this rating eventually, had a AAA rating. So what could go wrong, right? You were buying something, the underlying CDO, that was AAA, and you belt and suspended it with this complete unconditional protection against loss from AIG, also AAA. But of course, the guy selling it knows that the more he underprices it, the richer he becomes. And AIG can't even figure out, because it's supposedly financially illiterate, that maybe it should have not pay people bonuses until, like 10 years later, nor does it have any clawback provision to get the money back if it turns out the guy is running this kind of deal. And so the guy running their CDS unit actually made more money than their CEO, and AIG's CEO was very highly compensated. So, he walked away very rich, and the people of the United States got to bail out AIG.
Although
which
AIG
in
eventually
turn
did
bailed
pay them
out.
back, right?
Yeah, well, yeah, eventually, sort of, right? Is it that would you do a bailout of AIG if you were private sector?
I don't think the public sector should be involved in any of this, quite frankly. I think
Well, that's the point, right?
These are risks that the government shouldn't be involved in, and that people who want to risk their money should feel free to blow it however they want. But I don't think the government should be there cleaning up the mess, because it's complicated enough for the professionals who don't understand it. All the more so, it's complicated for government regulators who just can't control it. And without having transparency and understanding, the government really shouldn't be involved with taxpayer money. But in the end, I just want to note, I understood that the AIG deal, which was terrible, in the very end, they did pay back the money that they got from the U.S. government.
Yeah, but that this is a finance show. That doesn't cut it, right?
That in the end it worked out. Okay.
Yeah, that's not how we do things in finance. And AIG, it's worth mentioning, was the largest insurance company in the world. And so a whole lot of things were going to blow up. And this is in the context of having the largest run in world history occur within 3 hours of the bankruptcy filing of Lehman Brothers, that took down every money market mutual fund in America within about 3 days, with a run totaling over $100 billion. Because this is a run not by you and me and the people listening. This is a run by massive corporations and in particular banks. So the Fed and Treasury were looking at, okay, are we going to bail out AIG, or are we going to have this whole row of dominoes take the world, not just the United States, down into something far worse than the Great Depression?
Right.
So, you tell me, what you would have actually done as Treasury Secretary. And I tell you, the Washington phrase, where you sit is where you stand, has a lot of truth.
All All right. I know that there's a lot of truth in what you say, and unfortunately, we are just about out of time now to hear more of it. But I know there's a lot that you write and talk about to allow people to learn more about some of these issues, which I think it's important for individual investors to see, sometimes to peek behind the curtain and see what's going on. And a lot of times it's very scary. So, Bill, in the last few seconds, just tell us, how can people follow you and follow your work?
So they can see the TED Talk talking about the crisis. They can, we hope, come to New Economic Perspectives, which is the blog of the University of Missouri Kansas City Economic Department, which has not just that, but since I'm a white-collar criminologist, we got a whole lot of stuff on elite fraud and corruption.
All right. So
and what to do about it.
Okay, we will put links to that at the show notes of today's show, as well as to your book at the show notes today at goldsteinongelt.com. Bill Black, thanks so much for your time.
Thank you.
You've been listening to the Goldstein on Gelt show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.